Do you know that you are going to lose money in all investments? So this is a topic I thought it's very good to speak on in the morning time. And when I started noting down the risk and associated risk in all the investments, I thought it's a very huge topic. So it may get longer if you're interested to know that all the investments, whatever you're doing, there is an associated risk with it and how to handle the risk, which I'm going to reveal towards the end. Are you interested? So, hi, hello, this is Ganesan, your millionaire coach and author of the book Money Leaks, and I help you in creating wealth. So, today's topic is much interesting because people think that FDs are a bit interesting, there is no risk associated with it, but there is a risk associated with it, which was not revealed till now, and your bank deposits and everywhere, right? So let's understand what is risk. Let's go by the way, like, which is very high risky and then low risky kind of stuff based on common perception. It's not my perception, it's a common perception I'm saying, right? So the first and the common thing is stock market is the most riskiest investment, right? Everybody agrees with that. And as people started investing in mutual funds, they started thinking that mutual fund is also risky because it is associated with stock market. Anything associated with stock market is something like risky, you should not invest, and because it's a gambling place. Because this is the common perception everybody does. Do you agree with that? If you agree with that, please type and agree in the chat box so that we know how many people are agreeing with this common fact about stock market and mutual funds, right? So what is the associated risk? What if the company goes down? What if the mutual fund goes off to the if I lose every all the money whatever I invested? These are the associated risk in any kind of investments. Am I right in saying? Because there are stories like your investment goes off, the company gets shut down. I had a friend who was having his portfolio which was invested in 1985, almost 35 years, even before I was born. So when I checked the portfolio, almost out of the 10 companies they had invested, 6 companies were delisted, and we need to find out to sell off the remaining 4 and invested in another stocks. So these are something like which nobody expected in the 35 years, 6 companies getting delisted. But the point is he didn't monitor for the last 35 years. That is the point. And at the same time, there are companies like ITC, Infosys. Infosys got listed in 91, but right from 79, we have TCS, not TCS, we have Hindustan Unilever, ITC, and Tata Steel, and these are Asian Paints. These are companies which are listed from that time, and till now they are successful. If you had invested few hundreds, 100 itself is a big amount in 80s and 90s, I know that. If you had invested a few hundreds, that would have created a huge wealth right now. But are we doing that? No. So the risk associated with it is which company you are utilizing, which company you are investing. That is the only risk associated with stock market. If you are able to understand the business, if you are able to invest only the known things around you, either in your business or your personal life, the risk associated with stock market can be easily just, you can hit like 6, it will go off. So that is the only advantage with investing in stock market, because remaining things are not in your control, and because in stock market alone you are going to take your decision, you are going to invest your money, you know what is the risk associated with it and whether you can trust that company. All these stuffs are, you are going to take the decision, I am going to take the decision. Okay, even in mutual funds the same story. Okay, let's come to mutual bank deposits and post office deposits. This is something like everybody says that it's a very riskless investment as bank deposits and post office deposits. But the problem, do you know, your deposits are only insured up to 1 lakh till last year, and only in 2020, based on our finance minister's view, it has been increased to 5 lakh. Your deposits has been insured only up to 5 lakhs of your investment. So any other investment, say your, for example, so many banks that got bankrupted in the last 2 3 years. PMC Bank, that news came in last year, and it happened in Maharashtra. And because of that one bank, they had increased the insurance. It has been managed by Deposit Insurance, a separate firm, a separate management team. I think RBA governed something regulatory thing, but they are doing that, and the insurance the coverage is only up to 5 lakhs. Say you invested 10 lakhs of your retirement amount and only 5 lakhs is being insured, your 5 lakh goes off. Only when the bank gives a regulation, gives something, then only you'll be able to get that. But these are the news which will never come, because we won't let bigger banks to dissolve. So there are people who had invested in small banks all across the world, all across India, small banks in Maharashtra. Even in Maharashtra, there are certain communities who invest in this bank, who had expected their money to go off like this. They were not allowed to take that money for the first 1 or 2 months, and then slowly the limit has been increased. But unless and until the bank gets the money from the lenders, it's borrowers, not lenders, borrowers. It's difficult for them to give the money, and that is a huge problem. So the risk is there even in bank deposits, and even the post office deposits is the same. The coverage ratio and everything, and along with that, there is one more risk called interest rate risk. Say you had invested this month at 5.5%, and suppose the bank RBI wants to reduce interest rate within the next 3 months. Say you want to renew another deposit in the month of December, it will fetch you only 5% instead of 5.5%. So the interest rate gets reduced automatically. You will be getting only lesser interest rate. So the risk associated with bank deposits is such that you are not doing any mistake, but the regulation, and because of the certain external factors, automatically the interest rate is getting reduced, automatically your returns are getting reduced. And another automatic thing what is happening here in this is that inflation is something very very high, and you are not even beating the inflation. So automatically the investment, whatever you are doing, a 1 lakh investment, it is going to fetch you just 5%, whereas the inflation right now is around 7%. Next year your 1 lakh is worth just 98,000. Are you okay with that? And along with that, the TDS it attracts. Your bank deposit is giving 5.5%. The 5,500 rupees on that TDS will come at 10% or 20% based on your tax slab. So finally, your amount, whatever your 1 lakh is going to be at the end of the first year, is somewhere around 97,000 or 97,500. Is it good? Is it not the huge risk? Because you people are not even thinking about how to these risks exist, because these risks exist, and it's like conditions apply. Whenever you purchase something, there will be at the top like a star, and they say the conditions apply. These are conditions apply which is existing for a long period, and interest rate has got reduced. India is moving towards reduced interest rate. Inflation wants to be around 4%. If inflation is around 4%, automatically the interest rate will be reduced. And we can't, and currently in the current scenario we can't afford to increase the interest rate, because government is trying to revive the economy. During all these scenarios, just think of, all these are outside your hand. Can you increase interest rate? Can you reduce the inflation? Nothing is in your hand, but your deposit alone you are putting in the bank deposit, thinking that that is the only avenue available. So who to blame in this case? So is it the government, or is it the people, or the banks which are giving lesser interest rate, or whom to blame? So the risk is there even in bank deposits and post office deposits. That is the only point I just wanted to say. And another best investment we think is that insurance as an investment. We think it's easy to get insurance, and as well as along with two for one benefit. That is the only way the people are selling insurance along with investment returns, and they are giving interest rate. Now they are being selling at bank deposit rates we are giving better than bank deposit, which is around 5.5. Bank deposits are even lesser, deducting the TDS. So in this case they are thinking that this is one of the best investment tool in the current scenario after 10-15 years. But the point is, the same inflation risk is there, and again, if the bank deposits are still reduced, they'll not be able to pay for the next 10-15 years. There is an inherent interest rate risk associated with, even if there is a traditional policy. Even if it is a ULIP policy, it depends upon your risk, which investment you are investing. Are you investing in something like a mix of equity and debt, or a mix of fully 100% equity? All these things you are not considering the point. So if these things are not considered, insurance itself is not an investment. That is the first best point you should keep in mind. Even if you're investing, you're going to get around 4.5 to 5% looking at the current scenario, and it has inherent risk of, and the cost of the value. Currently 1 lakh is worth 1 lakh, and after 15 years, considering the inflation, the 1 lakh may be worth just even 50,000. But they are going to promise the same thing, the doubling, 2 lakhs. So your 1 lakh right now is going to be just 1 lakh after 15 years. Is it worth to invest in these kind of investment? right? So is there a risk associated with it? I'm just leaving it to your choice, because you're not considering how much your value. They will be selling you like 1 lakh, invest 1 lakh right now, after 20 years you will be getting around 2 lakhs. 5 lakh policy, you will be paying 50,000 per month for per year, and after 20 years you'll be getting around 20 lakhs, because you would have paid 10 lakhs and you would have got 20 lakhs. But the point is, the same 10 lakhs is worth, the 10 lakhs what is worth right now is worth 20 lakhs, almost like, considering the inflation, the worth of the 20 lakhs after 20 years is going to be just not even 10 lakhs, it's even lesser than that. All these are risks associated with that investment, so you should consider, you should know all these points. And the next best thing is real estate and bank deposits, sorry, real estate and gold, because everybody thinks these two are one of the best thing to do, and we believe that we can touch the gold, touch the real estate, we can feel the house, we can feel the commercial places. But the point is it generating, is it a real good investment? That is a next thing you should consider. But the point is, real estate in India has been very less. If you are looking for rental yield, it's not even going to give you 3 to 4% year on year. And if you're looking at commercial real estate, it's going to, it is having so much regulatory and everything, so you should be very much keen and you should invest a lot of money into it. And when it comes to gold, suddenly it kicks off. What happened in the last 6 months to 1 year? From nowhere, it almost like 100% returns in the last 6 months. That is what we can say. So this, nobody has expected the amount of this much amount of returns in the last 6 months. So just because of global liquidity, so many factors we can say, global reasons, but because nobody has bought gold in India, the rates had gone down. Even though the rates had gone up, nobody has went and bought gold, because the imports had gone down. That is the only way we can measure. And even in China, the same story. But the point is, globally, because of liquidity, because of uncertainty, people are buying gold, because no other asset is growing, has so much safety in it. People think it's for safety, but we need to think how it is going to work in the coming days and months. And the associated risk with it, gold prices might fall after 6 months, because after 2011 we had a huge fall for almost like from 34,000 of 24 karat gold has gone down to, in India price I'm saying, it went down to 24,000. Right now it is around 57,000. Even it might go down, but if you look at the long term returns of 30 years or 40 years, it's again around 8 to 9%. And it's always considered as an inflation hedging tool. But the point is how much effective it is, because the asset itself is not growing, but the value whatever we are giving to it is growing. Again, these are the points. Having the values and the prices in the hands of the government as well as the regulatory authorities, so we don't have anything in our hands. And real estate, if you see, you would have bought real estate for the future purpose, future investment growth. But the point is, what if something happens, some encroachers are coming on, what if the government is going to try take their land, the value is not appreciating? All these are risks associated with even in these physical assets. You know better stories than me, because everybody has their own experience when it comes to real estate and gold. So what you got out of all these things, whatever we discussed today, is that any kind of investment is having a risk. But what is that one risk which is with you, which you can control? That is the only thing you can control. That is the only place where you can take control, because whenever your life is in your hands, if you believe that, your risk is also in your hands. If you understand, if you can spend some time in understanding about stock market and mutual funds, and understand that in the long term this is going to help you, the risk gets reduced in these financial assets, because it is in your hands. You are going to control the investments, you are going to control the risk. But when it comes to any other asset class like real estate, gold, or bank deposits, you don't have you don't have any kind of control, because interest rate are with regulatory authorities, RBI and banks, inflation is with them, post office also the same story. And even if you think about insurance is again, people are selling like anything, because people are going to give you informations, and it can be taken in a positive way, because they are going to tell you that it's your safety, amount should be safe, all these things what the selling agents are going to tell you. If they tell in that point of view, automatically we will consider that, okay, if that person is going to telling in my safety point of view. But the point is, why you need insurance? It is for risk managing purpose. But which insurance agent is going to tell you, is it going to fetch you good interest? It is going to protect your family, protect your life. Nobody is going to tell you, right? That point of view, no, none of the person I have seen, they're only focused on selling. So please consider everywhere the risk is associated with it, but know the risk and then invest. So finally, I'm just going to tell you that point. Mr. Rakumar asked where to invest finally. So can you control risk? This is what I've been telling. Like, you can control risk which is in your hands because you know the analysis now, right? Whatever I told in the last 15 minutes, it's all about every investment is having risk, and every you should get that fact, like, in this investment what is the returns I'm going to take, and is it okay to stay invested in this for the right moment. If you're investing for the next 1 or 2 years, if money is really needed, you need to take the interest rate risk and lock your money for the next 2 years, say 6% or 7%, because capital is more important. Say you don't need that money for the next 5 plus years. You can invest your money in stock market, because only in the quality stocks. That kind of knowledge you should learn, so that learning brings in earning. So learn to earn. So that is the only thing I just wanted to say. So if you can learn that stock market, right kind of stock analysis, if you're able to do that, you can learn, and as well as you can invest in stocks, which is going to fetch you. Mutual funds, the same story. If you're investing for the initial 1 or 2 years, automatically you should make sure you are investing only in the capital protection investment, in a pure debt fund. If you are investing 5 plus years, yes, you can invest in mutual funds or stocks. The choice is yours, because a mutual fund manager is going to take your choice. The returns are going to be fair, maybe around 8 to 10% or even 11-12. But stock market, if you're taking your own risk, if you understand the stock market and invest, the returns are yours. You are learning, you are understanding the company, you are investing, and the returns is not 12%. It can be even 30, 40 or 100% in a span of 2 years. Isn't it huge? You can't make that returns in any of the asset class. And learning is the only part which you can do, and which will make you clear that risk is very less, and then it will take you to the top 5%, because stock market is the only place where I purely believe that you are making your money to work for you, and that brings in a huge wealth creation in your life, right? So the risk which you can take, please take that. Which you can't take, you need to understand where to invest. The first point, within 1 or 2 years bank deposit, it's okay, because capital protection is really needed. If you have more than 5 years plus, 5 to 7 years more than that, you can invest in stock market, mutual funds, and real estate and gold. Not as an asset class, I won't agree to it. But if your commercial real estate investment is going to fetch you returns, rental yields, which is currently there are new age investment people who are doing that, please go and invest in that with commercial rental yield which is possible. So that will help you in generating yield. That is the real investment. That is what Robert Kiyosaki advises. Your real estate investment should not be a liability. It should be yield returns, so that it's growing, right? So that is how you should check. And finally, gold. Maybe already in all our families, like, we are generally so emotional guys, we always have some gold as part of the marriage plans. Unless you are a single, you might not have money, you may not have gold, but at least your family will have gold. Consider that as an investment in your life. See, you should have more gold apart from that. If you want to buy, if you want to hold, go to gold ETF, buy that, or sovereign gold bonds, which will be there in your life, which will be there in the digital world, not as a physical. You don't need to worry about should I maintain, and you need to keep that in a bank deposit. Again, it's a risk, and again, there is associated cost involved in it. So let's leave all those things. Let's invest in digital gold. Let's increase a liquidity ratio, like financial assets, so that you are growing in a healthy manner. Investment, if you want to buy your own home, that is okay, but take time, maybe 5 to 10 years down the lane. Don't go for liability EMIs. Just buy this and then do, because it's not an investment, it's a liability. If you're living in your own home, it's a liability. But if you want to look at it as an investment, it should yield, which should yield rentals, right? So hope things are clear. If you have any questions, please post it in the comment section. Hope I answered all your questions. So there is a risk involved in everything, so please understand that and take control of your risk. And it's up to you. Do you want to come to the top 5%? That is the series we are doing it, where you make your money to work for you and you attain financial freedom. If you like this video, please click the like button, and please share this video with your friends in your page, so that they also know much more about top 5% and how to make their money to work for them, so that financial freedom is on the way. Take the first step to freedom and you will feel it. Thank you so much for watching. Please share this video with your friends. Thank you so much.